Hello, and welcome to Connected with Latham, where we discuss ideas, developments, and trends shaping the global economy. I'm Ben Potter, a corporate partner in our Silicon Valley office, and in this episode, we're going to cover key developments in growth debt. For that, we're talking to Haim Zaltzman, a colleague in the Bay Area and a top-notch finance partner with tons of experience in tech and life sciences. Haim handles more than 100 growth debt transactions each year in these two important high-growth sectors. Okay, Haim, let's get to it. Let's start with an obvious question. What is growth debt?
Absolutely. So growth debt means different things to different people, but this is how I split the world of growth debt. You have four major pockets. The first pocket is the venture debt. That's what classic people think of, startup, young company debt. It's when there is an explicit, different from implicit, an explicit backing from the venture capital firm that they will fund the next round, i.e. there's no way for the company to be able to pay down the debt long term without continued equity support. These are relatively early stage, although depending on the company, it can be up to a Series C. And then what I look at as a next pocket is what I call structured debt. And they could have some elements of the venture debt companies. They're still startups. Now they, particularly on the tech side, they usually have some sort of traction that justifies larger facilities. So the most common and important one is revenue. Some sort of revenue source, some sort of licensing deal, something that brings in money so that the lender can actually evaluate and finance something that's more tangible. They still need to have the growth. They still need to have support, but now the support is implicit rather than explicit, because the deal sizes are large enough that lenders would typically not expect the equity, the sponsors, the venture capitalists to come in and quote unquote save the day. These are also, again, tech and life sciences, larger deals. The third one is royalty financings. And again, here you're specifically, again, looking at the revenue potential of a specific asset. More common in the life science side, where you will finance a certain intellectual property, a certain molecule that's out there selling in the market, and you can do a loan that's either specific to that asset or with the broader company. And there's quite a few lenders who do this. It's more or less popular depending on the time and where we are in the economic cycle. It's a bit more popular right now. 5 years ago, it was less popular. The last category is what I call the Haim special, the catch-all. And that's basically anything that doesn't fit perfectly into the first three categories, but is not yet cash flow positive enough, that has 10 million in EBITDA or 15 million in EBITDA, but has some interesting assets. So the classic example I give is IP-backed loans. If there's a company that has an amazing patent portfolio, there are lenders who will finance it largely based on the patent value, either licensing, litigation value, enforcement value, or market value of the patents. Those are the four categories that we kind of look at. And they do bleed together. The boundaries are unclear in some areas, but again, I break it down into venture, structured, royalty, and then the esoteric catch-all, what I call the Haim special. I call it the Haim special because those are the ones that I don't know what to do with, so they're special, and people give me a call about it.
So growth debt equals venture, structure, royalty, or esoteric hyphen Haim special. Whenever my clients start using words like that, I send them directly to you. But help us unpack a bit why, for the entrepreneurs listening, they should be considering growth debt in any of those categories as compared to equity or growth debt opportunities at large at the moment.
Ben, one of the main things I want to take a step back and explain is one of the differences between this area of debt and other areas of debt is that it really works together with the equity dollars. In other areas, the companies are profitable, they may never need another equity round. They may never need another equity check. I mean, if you're doing acquisition financing for private equity companies, you're hoping that equity investment is what will carry you there with the debt, and that the cash flows will pay down your debt. That is not the case in the growth debt area. And it's a very important point because usually the debt, or almost always, the debt comes in with equity or works with equity. So in a traditional venture capital round, if the round is supposed to last for the company for 18 months of operating costs or cash or burn, as we call it, the traditional rule was that the debt could come in and add another 10 to 12 months of runway. And runway is very important for growing companies because the longer you can delay having to take more money the more you grow, the better your valuation, assuming you're hitting your metrics, are down the line. So if you're only going to be worth X when you're 18 months, you would hopefully be worth X plus 7, X plus 8 if you got another 8 months. So the debt is really important in being able to extend that runway. And in terms of companies and why they should do it, the debt looks at the position of the company, its growth trajectory, where it's at, some of the elements that I just talked about, and it wants to make sure that it's first to get paid in line and that it will not have quote unquote equity risk. Assuming you meet those characteristics and you can get the debt, for companies, the cost of capital is extremely cheaper, significantly. If the average cost of capital for equity is between 30 to 40% rate of return or higher, if you look at it globally, debt is anywhere between 5% on the low end to 15% on the normal average. So if you're looking at 5 to 15%, that's an amazingly cheaper rate of return that you have to pay versus 30 to 40. Even if more expensive debt, i.e. larger dollar amounts, riskier debt, it's significantly cheaper than the equity. So from a company's perspective, using debt as a way to extend runway to add for growth, be able to do everything that they were planning to do, makes a lot of sense. And there are obviously risks to debt, particularly secured debt. You have to pay it back. This isn't like equity where somebody makes an investment and they can lose their money. The debt providers, the lenders, expect to get paid back. They really cannot lose principal. So they're going to be tighter. There's going to be covenants. They're going to be secured. Most companies are okay with that risk because if they don't grow and develop and have that push, they're not going to be successful with either the equity or the debt dollars, and they may as well take the cheaper cost of capital to be able to push them on that horizon and be more successful. Although there are some conservative companies who have decided that they don't want to do debt because of that risk. But I will tell you, that's hardly ever the case anymore. When I first started looking in a debt in this growth debt market that was still in its baby years, from my perspective at least, in 2008, only somewhere between 40% of our companies had some sort of third-party debt, quote-unquote growth debt. Now it's almost 95%. It's become pretty ubiquitous. To answer your questions, why do companies want it? Why do we see it used? The answer is it's cheaper, and it can significantly propel your runway forward, which is hugely advantageous from a valuation, from a growth perspective.
Thanks, Haim. So that's a great framework for thinking about the why. What about the when? At what point in a company's life cycle should they be thinking about going out and getting growth debt?
Sure. And unfortunately, the answer is it varies a bit industry by industry. For life science companies, there's been a phenomena since 2012 or so way back, with the crossover round that they're trying to position a debt for their big equity round before they go IPO, which they can do pretty early on. For technology companies that don't have particular assets, they try to get it earlier on. But to answer the question generally, it all depends on how well the company is doing early enough to be able to show some sort of traction to the debt provider, either a revenue or a licensing contract or clinical development with a very clear timeline for a regulatory success point. Assuming they can do that, their debt providers, it'll start a cycle, including very small facilities. We see facilities for seed companies. I mean, we don't see them that often, but we do see them. For a while, those were pretty hot. Those have become less hot, more because the money has moved more upstream because the lenders need to put out more money. So doing $500,000 or $1 million facilities is really hard to put up enough money. But we definitely see those facilities with certain lenders. And, as early as, so the answer is as early as a Series Seed, but definitely see it in a Series A. And, if somebody had to, when should I absolutely be thinking about it? It's probably the Series B. The Series B or right before the Series B, lining up with the Series B, think about it, the Series B. Now, if you're getting that extra check after you've done the Series A and you've gotten that element of support from the market and from your VCs and you're ready to move to the Series B, that means you have enough qualities that would make sense to significantly extend your Series B towards a Series C and onward.
Thanks, Haim. That's super clear. So we've got the what, we've got the why, and we've got the when. What about IPO? How does the IPO plug into this equation? Do the lenders typically participate in an IPO process? How do we want to plan growth debt around an IPO readiness or an IPO planning project?
Usually with an IPO, although it varies with life science companies who can access the IPO market usually a lot earlier than technology companies. But usually with the IPO, lenders lenders love IPOs. There's almost no such thing as an unsuccessful IPO, notwithstanding what you hear in the market these days. If a company can actually go an IPO, they've gotten the validation from the market. So lenders love it. They would love to give some sort of facility, be it debt or even convertible notes that are pre-IPO converts and can convert into the equity, but even straight growth debt that is pre-IPO and have it be carried through the IPO. They would love to give a warrant that goes with the debt, because obviously the IPO is a good sign for the equity value with the warrant. So long story short is, if you see an IPO down the horizon, having debt in your mix and getting a debt facility right before is hugely advantageous and is a very common strategy for our borrower clients and for the lenders that fund them who love it. A lot of lenders would love to give a certain tranche pre-IPO, have the company hit the IPO, and then make another available tranche right after the IPO. The public markets love it because they know that the company is going to have access to very cheap money right after the IPO that will come in, obviously better for dilution purposes. So the public markets tend to really like these type of flexible, what I call dry powder facilities that are triggered with an IPO. The availability is triggered with an IPO. And obviously the companies love it because if they can get a tranche right before, they can reduce the amount of dollars they have to take in an IPO, which helps for dilution and valuation purposes for the pre-IPO investors. And then they also can have access to further capital after an IPO, which helps grease the wheels for the public market investors who know that there's availability of cheaper capital so that the company doesn't have to take more of that in equity. So companies that are on the path an IPO or planning an IPO, this is where the debt product, the growth debt product, always makes a lot of sense to think about, either in reducing the amount you have to take and, again, greasing the wheels in terms of having access to cash that is cheaper than the public equity money that you will get with an IPO, and generally to show validation from debt investors along with the IPO public investors. In terms of the IPO story, growth debt should always be in a mix for technology or life science companies that are thinking ahead of it, because there's almost never, like I said, there's almost never a situation where a debt investor, a lender, will not think very positively of an IPO in terms of lending before or making available funds right after.
Thanks for that, Haim. So you've spoken about the ubiquity of growth debt, and it sounds like a part of that is related to the maturation and the development of the product. You've also spoken about the cost of capital. Are there other reasons for why this has become a big trend or much more prevalent in the world we live in today?
It's a huge trend, and I think it will continue to be for multiple reasons. First one is what I just mentioned earlier. It always makes sense from a cost of capital perspective. So as companies look at it in a more mature way, the dollars and cents, the back of the envelope is unbelievably clear. You don't have to be a genius to know that 5 to 15% is significantly better than 30 to 40 or higher percent. And the more you think your company's worth, the more that's a good deal, even if you're giving a warrant with some upside. So that story over the years has made sense, and the thesis is now cut on to everybody, including the equity investors. The second one is what I call the collapsing of the markets. As we know, there are mature companies that have folks who came from iBanking world, who have folks who came from the private equity world. The mixing of both individuals as well as market trends with the VC world that used to be just much more equity focused has led to much more familiarity and comfort level and understanding of debt products. It's not where you would want it to be ideally, but it's definitely heading there. I mean ideally in that the private equity world, for example, is very, very, very conversant and very familiar with the debt product. It's actually part of its core financing strategy is to lever these companies up in a way that doesn't. And the more we've gotten mature private equity type players, the iBankers in the VC world, mixing each other, looking at similar companies, the more we've gotten the growth type investors, many of whom are Latham clients, working in the space, both in technology and life sciences, the more we have seen familiarity breed comfort and breed usage of debt products. Those are the first three reasons. And then the last reason is the need for capital is just unbelievable. It is absolutely great, much greater than it was before. Private companies that like to stay private longer, even companies that access capital, particularly on the life science side after IPOing, need a lot more capital to grow faster. It's a much more competitive world. The need for capital, and I'm going to repeat it again because I really want to get through, is unbelievable right now. And thankfully, The availability of capital is also been amazing, and it's actually far superseded the need for capital. The amount of debt funds out there, the amount of equity funds out there is just mind-boggling. And because of that need for capital and the availability of capital, much of it being from the debt fund perspective, it makes a lot more sense to take that capital in the form of debt than it does for equity, because equity is dilutive. It will hamper your valuation, while debt, assuming it doesn't quote unquote sink the ship, you don't over-lever yourself, is much more workable from a valuation and from a dilution perspective. So those are the three main reasons why the trend has been to utilize debt more intelligently, and utilize debt more efficiently for growth companies that you would have never seen 15 or 20 years ago.
Well, Haim, thanks for coming and being on the show. You've been a great participant and you're a great partner. Thanks again for all your contributions. Hope to have you back soon. Thank you for listening to this episode in our Connected with Latham podcast series. You can subscribe and listen to new and archived episodes of Latham's podcast on lw.com, Apple Podcasts, Google Podcasts, Spotify, or anywhere else you listen to podcasts. If you'd like more information about the topics in this podcast, please email us from links located in the show description. We hope you'll join us again next time.
This podcast is provided as a service of Latham & Watkins LLP. Listening to this podcast does not create an attorney-client relationship between you and Latham & Watkins LLP, and you should not send confidential information to Latham & Watkins LLP. While we make every effort to assure that the content of this podcast is accurate, comprehensive, and current, we do not warrant or guarantee any of those things, and you may not rely on this podcast as a substitute for legal research and/or consulting a qualified attorney. Listening to this podcast is not a substitute for engaging a lawyer to advise you on your individual needs. Should you require legal advice on the issues covered in this podcast, please consult a qualified attorney. Under New York's Code of Professional Responsibility, portions of this communication contain attorney advertising. Prior results do not guarantee a similar outcome. Results depend upon a variety of factors unique to each representation. Please direct all inquiries regarding the conduct of Latham & Watkins attorneys under the New York's disciplinary rules to Latham & Watkins LLP, 885 3rd Avenue, New York, New York, 10022-4834. Phone number 1-212-906-1200.